Hey there, finance friends. Welcome back. So we wrapped up the formal treatment of stocks in the Topic 29 video, but I wanted to give a little supplementary video, little extra time with Eric to make your day. But specifically what I wanted to do was put together a couple of real simple, well, maybe not so simple, but a couple of straightforward problems and solutions just to give you guys some practice to let you see how some of the most common types of stock problems would be solved. Okay, so what I encourage you to do, I've got 4 case studies. I'll go through them really quickly. Case number 1, assume the following data for the CAP Corporation, and I tell you that CAP pays an annual dividend of $2 per share. I give you the share price and other data. I want you to calculate CAP's dividend yield, CAP's EPS, and CAP's PE ratio. In case study number 2, we assume that we have 2 stocks. They give you the following data, stock A and stock B, and you have some data that you've collected. If you want a high cash return, which stock would you buy? Question number 3, assume that you have data on 3 stocks, stock A, stock B, and stock C, and you have sales price data, in other words, the price per share, and EPS data, earning per share. Question, what are the price earnings ratios? What are the PEs for each of these stocks? And all other things held equal, big assumption, but ceteris paribus assumption in play, if you were looking for long-term earnings, which of those 3 stocks would you buy? And finally, a big one, case number 4, to see if you can wrap it all up, and this is a complicated one. Assume the following, and I give you a bunch of data on the company. It's beta, its current share price, its EPS, its dividend, and its growth rate potential. And then I give you some market data, and I want you to answer the question of should you buy it and justify that. So what I like you to do, if you would like, go through each of these 4, pause this video now. I know it'll be hard to not have my voice in your ear at all moments of your day. Pause this video right now, go through these 4 questions, see if you can solve them, and then turn me back on, and I'll go through each case with you to show you how I would solve it and to see if our solutions are aligned, okay? And of course, if you have any other questions about this, we can cover it in lifetime lecture, or you can reach out and we can go over things as well individually via email or whatever you want to do, okay? So go through them, take a minute, figure it out. Pause me now, and I'll see you in a minute. And welcome back. That's a neat little thing to say. Let's go through this. Here's what I think you should have taken away and gotten. Let's do case study number 1. We are talking about the CAP Corporation, and I give you a bunch of data. You know that they're paying an annual dividend of 2 per share. Share price is currently 60 a share. Let's open this up a little bit. The company has reported profits of $600,000. They have to pay $100,000 in dividends to their preferred shareholders. Remember that common and preferred have different classifications and rights. And there are 100,000 shares of stock outstanding. I want you to calculate CAP's dividend yield, EPS, and PE. Let's do it. So first question. Well, the dividend yield is simply equal to the annual dividends paid divided by the market price. So this would be equal to 2 divided by 60, which would give you a dividend yield of 3.3%. Okay, dividend here, $2 per share. Market price, $60 per share. Plug those into your formula. There you go. Dividend yield, got it. Question 2, what's the EPS? Well, earnings per share. Let's figure this one out. We know that CAP, I don't like that E. Make that nice and clean. So what's our EPS? Well, we had to break this down in pieces and then pull them back together. We know that CAP reported profits of $600,000. We know that they paid out $100,000 in dividends to their preferred stockholders. And we know that there's 100,000 shares outstanding. Put a dollar sign there. So the EPS would be equal to 600,000 minus 100,000. That is their net profit that they brought in. And then you subtract the dividends that they paid. You divide that by the number of shares outstanding. This would be 500,000 divided by 100,000. And therefore, we would say that CAP has an EPS of $5. Okay? Critically, you take your net profits and then you subtract out the dividends that are paid to preferred shareholders. Okay? You get an EPS of $5. Number two, EPS is done. And number three, now that you have that, PE is simple. What's the PE ratio? Well, number three, the PE ratio, let's do it this way, will simply be equal to $60 because that is our current share price divided by $5, which we calculated as our EPS. This would give us a PE ratio or a PE multiple of 12, which basically means that you're willing to pay $12 in order to get $1 of CAP earnings. Okay? So those are some ways to crunch some numbers. Let's get case number two. You have some data on two stocks, stock A and stock B. Stock A currently sells at $40 per share, pays a dividend of $3.60 per share. Stock B sells at $80 per share, paying a dividend of $7 per share. Okay? By itself, those numbers mean nothing. But let's say that your investment criteria is that you are looking for high cash return. Given that parameter, it's pretty easy to determine which share you should buy. And to do that, you're going to calculate dividend yield. We would see that for stock A, the dividend yield, if you divide your numbers, is going to be 9%. And for stock B, if you calculate out your dividend yield, you're going to get 8.75%. Okay? Dividend yield, by giving you a per share basis, allows you to compare apples to apples, to compare two shares, even if they're selling at different prices and paying different dividends. So, all other things being equal, if your criteria was, I want high cash return, you would be better off purchasing stock B, because stock B has a higher yield. You would be paying less money to get the same amount of cash in. So B is preferable. Okay? Sorry, take that back, take that back. My apologies, I messed up. You'd be paying for stock A. Take that back. Sorry, you're going to want to buy stock A. Stock A has a higher yield, which means that you're effectively paying less money for the same stream of income. Okay, sorry about that. Stock A, higher dividend yield. Stock A, you're buying. My bad, didn't mean to freak you out. Okay. Case number three, you get some data on three stocks. Stock A selling at $35, reporting an EPS, earnings per share of $2.85. Stock B selling at $35, reporting an EPS of $5.35. Stock C selling for $35, EPS of 85 cents. Two questions. Question number one, what are the PE ratios for each stock? Well, if you calculate the PE ratio, you would figure out that for stock A, it's about 12.28. For stock B, it's 8.57. And for stock C, it's 41.18. Okay, those are your price earnings ratios. This is what you are willing to pay to get $1 of earnings. So PE ratios, got them. But now let's say that your investment parameter is this, all else held equal, You are looking for long-term earnings. That's your goal. You're looking for long-term earnings. Which stock would you buy? Now, note that there's a lot of different ways to interpret PE ratio. Okay, I'm going to offer you that I would do it. I would say that all else held equal, meaning risk factors and all that other stuff, if I'm looking for long-term earnings, I'm probably going to buy stock B. It's got a lower PE ratio, which means that I am paying less for $1 of earnings. That's one way to look at it. And again, you can interpret the PE ratio in many different ways. Analysts always do. Here's another way to look at it. If you look at it and you see that each stock is basically selling for the same price, but they're generating different earnings, I'm still going to go with stock B because stock B has highest earnings per share. Okay, I'm paying the lowest amount for $1 of earnings. Just another way of saying that with stock B, I'm getting the highest earnings of the three. And why is that important? Well, at least under my interpretation, and again, there's many interpretations. Under my interpretation, if I buy stock B, I'm more likely to see one of two things happen. Number one, because stock B has higher EPS, I'm more likely to get a dividend, which would be a source of future earnings. Or because stock B, again, is generating higher earnings per share relative to the others, I could assume that stock B is going to have more money to reinvest into the company and therefore to grow that company and promise me, or at least not promise, but hopefully give me higher future earnings. Again, there's lots of other ways to interpret it, but this is one way, okay? Finally, let's see if you can put a bunch of knowledge together and answer one simple question with a lot of data, okay? You have the following. And by the way, as an FY, this is the kind of thing you would get like in an MBA evaluation class. So if you didn't get it all, that's okay. But let's go through the pieces, okay? Assume the following. So you're given all of your info. Company's beta is 1.5. The market risk as a whole is 8%. The current T-bill yield is 0.5%. The company is currently selling for $30 a share. Earnings per share over the last year were $2.40 a share. The current cash dividend is 66 cents per share. And critically, really critically, the company is expected to grow both its EPS and its dividend by 15% over the next 5 years. With all of that said, here's the question. Should you buy the stock? That's a tough question, but here is one way that you would break it up. Remember, the question of should you buy is always about, is your expected return going to meet or exceed your required rate of return? So let's start off first by calculating an estimated required rate of return. And I gave you a formula in the lecture notes. That formula was your estimated required rate of return, which goes back to our risk-free rate plus our risk premium. We would say it's going to equal the T-bill rate plus beta times the market risk, which will equal 0.50 plus 1.5 times the market risk of 8%, which will equal 0.5 plus 12%. So we're going to start off by saying your estimated required rate of return, 12.5%. Let's put that up here. I need to clear some space. Okay, so we've got the first part done. We know that in order to buy this stock, it has to have an expected rate of return, an expected gain for you in excess of this. Okay, so we have that. Our next step is we need to calculate your expected rate of return. Okay, well, to do this, we got to go through a few sub-steps. So let's break them down. First thing I would offer to you is the current price earnings ratio is going to be $30 divided by $2.40 is equal to 12.5. Okay, 12.5 is your PE. By the way, it's a total coincidence that that's the same required rate of return. Total coincidence, don't conflate the two. So your PE is 12.5. What does this mean? Well, it means that you would be willing, in general, to pay $12.50 for $1 of earnings. Why is that important? Well, here's why. We need to do a little bit of time thinking. Let's do a little thing here. End of year, earnings, and dividend. We know that right now, we'll call it year zero, just to have a little baseline. Our earnings were $2.40 a share, and our dividend was 0.66 cents per share. What we assume, my friends, is that over the next 5 years, those are going to grow by by 15%. So we're going to take those earnings per share and that dividend per share, and we're going to grow that up by 15% per year. If you did that, let's do it in red so that we have some contrast. Year 1, 2, 3, 4, and 5, we would predict earnings of 276, 317, 365, 420, and 483. This is why the growth rate is so important, because we're going to assume that if this company comes through with what it said it's going to do, the earnings per share will grow at 15% a year. So we're going to have higher EPS values. We're also going to assume that our dividend's going to grow at 15% a year, which gives us more current income per year to 76 cents, to 87 cents, to $1, to $1.15, and to $1.33. If we add up all those dividends, we get $5.11. If we divide that by the 5 years in question, we're going to have an average dividend of $1.02. Okay? Now, here's what you do. We know that in 5 years, the earnings per share is $4.83. We also calculated that we have a PE of 12.5. You put those two together, and we assume that in year 5, the company's estimated stock price will equal the 12.5 PE multiplied by the $4.83 earnings per share. We put it together and predict that at the end of year 5, this stock will be trading for $60.38. Note that there are a lot of assumptions that go in here, and if any one of those assumptions is wrong, that $60.38 it's not gonna be correct, and you're gonna be screwed potentially. Okay, this is why it's so difficult, but I want to take you to the mechanics of it. So what have we done? Well, we've started off with a particular set of data, and now we've calculated an annual current income over the holding period of 5 years and a projected future income based on the growth in EPS and apply it to the PE ratio. Make sense? If it does, now we just put it all together. Let's get this out of the way here. Let's put it all together with the big formula. And what formula is that? Well, it's this. We said that to buy a stock, we have to have an expected return in excess of our required return. We need an expected return in excess of 12.5%. So to conclude this example, we have to calculate the expected return. And I gave you the formula. The expected return is equal to the average annual dividend plus the projected price per share minus the current price per share divided by the number of years we're talking. Let's make this bigger here. All of that divided by the projected price plus the current price over 2. Plug all those numbers that we've crunched out into this formula, and you would get $1.02 plus 60.38 minus 30 divided by 5, all divided by 60.38 plus 30 divided by 2, which will be $1.02 plus 30.38 divided by 5 divided by 90.38 divided by 2, which will equal $1.02 plus 6.08 divided by 45.19. And when you're all said and done, if these assumptions hold true, you expect this stock to have a return of 15.7%. So to go back to our big question, should you buy it? You ask this question: is your expected return meeting or exceeding your required rate? And in this case, 15.7% expected return exceeds 12.5% required return. So all else being equal, yes, you would buy this stock. Okay, this was a really long, complicated process, but this is the way, at least in theory, the mechanics of stock valuation and the decision to buy or not buy would hold true. Thanks for tuning in. Chew through these things, practice them, and I'll see you next time. Take care.